Scale is the blockchain that's truly built different. Explore more at scale.space/ecosystem and follow them on X at Scale Network. Hey everyone, before we get into the show, just some quick housekeeping notes here. We're conducting an audience survey of the Forward Guidance audience, and we're just trying to gather feedback on what are some of your favorite parts of the show, what could you see improved, and what's your general vibe of things so that we can try and improve it. So the link to the survey is in the show notes. So if you could fill it out, that would really help us with improving the show for you as we move forward into the year. Thanks, everybody, and back to the show. All right, welcome back to another episode of Forward Guidance. And joining me today is, to say the least, a repeat guest, Danielle DiMartino Booth, CEO and Chief Strategist of QI Research. Danielle, it's been due time for you to get on the show now that I've taken up the mantle from Jack. So I'm really happy to have you on here. How are you doing?
I'm excited to be here with the next generation, so to speak. So thank you for having me.
Well, it's been a lively weekend to say the least. We have a lot of different tariff headlines coming through. It looked like as of Friday that we are going to be getting 25% tariffs on on Mexico and Canada, 10% on China. We've seen this morning some updates in that regard in terms of the Mexico side of things. It looks like they have some form of a deal taking place where the tariffs are now delayed a month is what's being said. And we're still waiting to hear back on what's going on the northern side of things with Canada. And a little update on the China side of things. So I would love to just start for the top line of what's your framework for thinking about these dynamics? How do you think about how likely it is that these are going to occur? And then how do they transpire into the actual economy itself?
There's a lot to unpack there, and what's interesting is, from my perspective at least, it's trying to figure out what the signal is when we're like living in real time chaos here. And there's a lot of practicalities when it comes to tariffs, and I think that the United States is running into them very quickly. Whether you're talking about Canada or Mexico, the impact that it would possibly have, primarily right now, at least on U.S. manufacturers. The Cato Institute put out an interesting piece last week that showed that one capacitator crossed the border 6 times. Including into Canada and into Mexico, before it was actually completed. So on a practical level, it'd be very difficult to levy tariffs in this kind of environment because in a lot of ways, American manufacturers have been encouraged in recent years to build their supply chains out to be friendly to our neighbors to the north and to the south. And in a sense, they've complied with the wishes of the US government. And now this is kind of coming back to bite them. So all very complex negotiations that we're talking about. And we have to realize that these are negotiations. But carrying them out is a whole nother set of challenges. And we're just going to have to wait and see what happens. In some ways, we were talking right before we got started. In some ways, you would need the assistance of the United States. And when I say assistance, I mean assistance of military on the ground to really press fully forward with tariffs in Mexico, because the drug cartels on a practical level have taken over so much of the operational capacity of the country in recent years. It's a very tall order to be asking what we are of Mexico without offering to help them at the same time.
It feels like one of the big things everybody's trying to piece apart in terms of these tariffs is how much of it is a tax revenue replacement for cutting income taxes versus how much of it is just taking a loaded gun, putting it on the table during trade negotiations and just saying, here's a loaded gun, we'll use it if we have to. It feels like the market is trying to figure out which way are things being tilted? Is it the Scott Bessent side of things, or it's more this negotiation tactic, or is it just we want to replace income taxes with tariffs? How do you think about that dichotomy?
Well, I mean, the problem here, the disconnect here is that the new Trump administration wants to accomplish both. And, they really do want to fulfill campaign promises made. They want to raise tax revenues. Not a very easy thing to do if you look at the actual history of what happened in 2018 and 2019. And on the negotiating tactic side, you have to wonder how much of this is backdoor trying to strong arm China because of some of the relationships that have been built up, whether you're talking about the Panama Canal or whether you're talking about China's presence in Mexico's industrial sector.
And something that also a lot of people have been trying to figure out is what's the impact of tariffs on the economy. So, economists such as yourself, they often talk about, okay, is it a change in the price level or is it actual, fundamental change in inflation? Is it a one-time pass through? And then also, how does that lead into the reaction function of the Fed? This is, the big question du jour right now. It's just like, okay, is it a one-time pass through? And we're going to look through it. You brought up the fact that in recent weeks we've received some transcripts from 2019 from the Fed in terms of how they were thinking about these dynamics back then. So I'd love for you to just piece apart trying to leverage those transcripts for understanding, are they going to view it as a one-time pass through or as fundamentally inflationary?
The fact that the 2019 transcripts were released the same day as the FOMC statement, I think was curious and was certainly targeted on the part of Jay Powell. And walking through, it's not an easy thing for the media to do when something is 5 years lagged and issued, and it's just a ton of information at once. So how the media managed to zero in so quickly on the fact that it ended up slowing growth and actually hurting job creation in the US manufacturing sector it was a sign to say we're not so sure that this is going to be initially inflationary as much as it's going to pose a threat to US growth going forward because of the experience that we saw in 2019. And I think that this is where policy making for Federal Reserve officials becomes so risky, so tenuous, because there's no absolute, this is, rinse, wash, repeat. We don't know that tariffs are going to play out the same exact way, but we do know that they pose a threat to growth. Given what we saw, whether we want for it to be the case or not, we exist in a world of global trade. And the fact that global trade for the full year 2019 contracted had very real repercussions for the US economy. The US economy has never not slid into recession when global trade has contracted on an annual basis, as was the case in 2019. And so there's a balancing act that the Fed has to navigate as it's making policy as to whether or not we're going to see more of an inflationary impact or a slowdown in growth, or potentially both, which would be a stagflationary outcome, which is kind of your worst of both worlds type of outcome. So it's difficult going for the Fed. That brings us really to the other source of headlines over the weekend and since Trump got into office, and that is what's going to happen with the US labor market, given where it's starting out with continuing claims at the highest level since 2021. What happens if we start to see the ripple effect into the economy of one of the largest sources of support for the job market being government job creation? And that's mainly been a factor of state and local job creation, but that was a byproduct of all the federal funding that the states were receiving from the COVID spending. What's going to happen if that begins to reverse? And on top of that, if we begin to see job losses at the federal level, and that's why you bring in the parallel of what it was like when Ronald Reagan first took office after a big spurt of government hiring in the Carter years, if that was to be reversed. These are very disinflationary prospects that we're describing here, which has not, been spoken about
Mhm.
widely.
Yeah, absolutely. I'd love to double click a bit deeper there on the state of the labor market. We had the employment cost index come out this week, and it's very interesting. I know in some research you've been putting out, just comparing that to the duration of unemployment that's occurring right now, and then to your point about continuing claims, continuing to creep higher. But at the same time, initial claims are relatively low. And I'm just curious about, as we look at these different factors, this is what's so important about the labor market, is you need to look at these different variables. It's not always just about, looking at unemployment rate and then getting a pulse there. So when you look at these dynamics, like where the ECI came in, duration of unemployment, the job openings rate, obviously that's come down. We've seen a bump. And I'm just curious, like, how do you characterize the current labor market? It feels like it's on a precipice where it just takes a little bit of a prick to it and it could just cascade. But at the same time, we're still, considering walking this line. So how do you think about all that?
So, I mean, I think one of the first things you have to appreciate, and you're right, you have to look at this piece by piece by piece and then put all the pieces of the puzzle together. And one of the things that I emphasize in my research is the footprint of the gig economy in not just the United States economy, but in the world economy, that really has acted as a shock absorber. And one of the reasons that we're seeing initial jobless claims as well behaved as they are is because you have millions upon millions of jobs that have been created as jobs have been lost in the gig economy. So in 2009, that was the year that Uber was born in Paris, France. And the fact that it didn't exist back then makes drawing parallels very difficult today. But just getting to the nuts and bolts, the average, most US states have about 26 weeks of unemployment benefits that they pay out. At the short end of the spectrum, you've got North Carolina, Tennessee, Florida. They only pay out 12 weeks of unemployment benefits. And if you're topping out around $300 a week or so, that's going to make a material difference in terms of whether you file that initial jobless claim or not. And what we've seen is we've now got part-time employment up to some of the highest levels in recorded U.S. history, partially because so many are opting to not file that initial jobless claim and become an Uber driver or a Lyft driver instead and make 3 times as much as they would have been making had they been collecting those unemployment benefits. It's simply the math of, do I pay my rent or not? Uh, as for individuals who are continuing jobless claimants, again, we're seeing that at the highest level since November of 2021. The other way that that's manifesting as we're seeing wage inflation come down is that the median duration of unemployment in this country is 10.4 weeks right now. And you've got to really go back to September 2008 to see a parallel duration of unemployment. And it goes to show you, as Jay Powell said at the podium last week, if you lose your job in the United States, it's very difficult to get a new one. And that we track by looking at the median duration of unemployment. And again, what we're seeing with wage inflation come down, it's half of what it was at the peak. So again, a lot of pieces of the puzzle that tell you that the US job market is really in quite a fragile state right now.
I'm curious if you looked into the research of how to measure that uptick in the gig economy. Is it looking at part-time workers for economic reasons? Does it show up there, or is it a lot of just like under the table cash stuff, or how do you measure that just to validate that idea?
So the easiest way to do so is to draw a parallel between the growth of Uber drivers over a short period of time and expand that out to an understanding that it's more than just Uber that's out there. So there are about 5.5 Uber drivers just a few years ago. Now there's pushing into 8 million Uber drivers. So just looking at the magnitude of that growth over a several year period and then saying, but there's also DoorDash, there's also Lyft, and there's also another complete underground economy of individuals who might not want to jump behind the wheel of their car and drive, but yet they're getting side gigs. And is that being reported? Are we seeing that? Is that part-time for economic reasons, or is it just simply part-time work? But it's when you look at the combination of the two, when you sum part-time workers for both reasons, you're getting upwards towards 10 million workers, and that's a lot. And that's what we're seeing on the books and reported.
Yeah, it feels like what we've said is that it feels like there needs to be some sort of catalyst to go from this current situation of being on the precipice to a cascade of potential layoffs, et cetera. To say the least, private payrolls have been in the dumps for a while, and we've just sort of floated through because of public government payrolls. There's two questions I want to ask you in terms of potential catalysts. One is what Elon Musk and Trump is doing in terms of just federal worker situation. Could that be one of those catalysts? And then as well, if you could just unpack, I know we talked about this previously, but in terms of the state funding and in terms of COVID era stimulus and how that trickled into an upsize in hiring for the state workers and where that stands now. I believe you mentioned that it's basically trickled out, and that stimulus is basically gone. So we'd love to just unpack those two.
So you're right. COVID era stimulus spending from the federal government into U.S. states has largely been exhausted, and we've seen Washington State as the first example out of the gate uh, announce that it's going to have a hiring freeze, that it's not going to be able to expand payrolls anymore, that it's not going to be able to fill open positions. And what's curious here, and as an aside, is we've seen a similar dynamic play out in the private sector. So you'll see maybe Meta Corporation say that it's not going to be filling existing positions, and or you're seeing job losses by way of attrition in the private sector. But as far as state and local spending goes, that source of growth is actually turning into reverse. We're seeing a unique phenomenon right now in U.S. states, and that we're seeing a lot of public schools close. Some of this has to do with migrations within cities and away from more rural areas, but it's a very real phenomena when you start to see the closures of schools, because that's going to take the largest driver of state and local spending is education. And when you start to see a reversal of that, that's going to have a very real impact going forward. And again, the funding has run out. And from what we're seeing from this new administration, from Treasury Secretary Scott Bessent, from Elon Musk, is that they have every intention of trying to be as aggressive as they possibly can in cutting spending to the federal workforce as well. So you could have a situation where you start to see not just a reversal of state and local government job creation, but to see a reversal of that in addition to job losses at the federal level at a time when we're seeing the bankruptcy rolls continue to increase. A lot of this is just a function of, gee, it's the beginning of the year. We're seeing some major retailers declare bankruptcy. But again, it's a matter of a baton handoff or not. Is the private sector going to be able to absorb some of these job losses when we're still seeing bankruptcies run as high as we are in the private sector?
Scale is the blockchain that's truly built different. Forget gas fees and waiting. Scale offers a seamless Web3 experience with fast, fee free transactions. Whether it's gaming, AI, or next gen dApps, Scale is here to power your future. Explore more at scale.space/ecosystem and follow them on X at Scale Network. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through its Ledger Secure Chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. I mean, it's clear over the past few years that we've effectively floated ourselves through based on government stimulus, and there probably would have likely been some form of a recession, or perhaps there still was in certain sectors. But from the top line level, a lot of it has been floated through via government stimulus. And I'm curious what you think in terms of how aware and okay are folks like Elon Musk and Scott Bessent with the fact that if they remove the catalyst that kept us going well, things could get dicey. Are they okay with that? And it's just a willing sacrifice they want to make, or what do you think they're thinking?
The bigger question is, if Besant and Musk are on board with the idea of short-term pain for long-term gain, what is their boss saying? And it's a strange thing to even say Elon Musk has a boss, but is Donald Trump on board? And I think that that is really the question, because if he's going to gauge his value and if he's going to gauge his performance based on where the stock market is, then you could certainly see some conflict arising there at the juncture of what Besant and Musk want to accomplish and what Trump is willing to accept. So far, I mean, so far is not just a few weeks now that we're talking about, but I actually heard Trump say the words short term pain in an interview that he did just a few days ago. So if he's on board with this, then we could see a dicey situation become kind of a full blown recognized recession at a time when, bear in mind, whether you're talking about the University of Michigan or the Conference Board, 50% of American workers now see the risk that the unemployment rate is going to be rising. In the past, when we've seen that Rubicon crossed, we've seen the unemployment rate start to rise appreciably. And again, this is the risk that's out there, is that we do indeed start to see the unemployment rate that's at 4.1% based on just a one factor regression, based on the number of Americans who believe that the job market's going to be tighter going forward. They place the unemployment rate right now at 4.6%, just based on their perceptions. And again, you have to listen to what people on the ground are seeing. You can't ignore all of these articles that say, I'm on LinkedIn, I've been trying to get a job, I put hundreds of applications out there. I'm a Harvard MBA. 3 months after graduation, I'm not getting a job. These are very real anecdotes that are being shared on the ground that tend to manifest in hard data going forward.
one last major catalyst to bring in there as well is obviously, Scott Bessent's been confirmed as Secretary of Treasury now, and we're actually going to be getting the first quarterly refunding announcement this week with him at the helm. And he's obviously been a large critic of what Janet Yellen has been doing there in terms of tilting towards bills issuance. And he's outlined quite a bit about how we need to get back to a debt situation where we can issue more coupons and get to better there. So my question for you is obviously if we're gonna pull back on government payrolls and deficits and that like that's a really great way to slow down growth and get people to start buying long bonds. Um, do you think that's something they're really thinking about? It's like, okay, if we need to issue more bonds, if we have a slower economy, there's going to be that higher marginal bid.
So I think that I do think that Treasury Secretary Bessent is serious, and I also think it's mature and good for the long term health of the country to have our assets and liabilities line up a little more logically going forward, not just trying to buy time 1 month at a time, or 1 quarter at a time, if you will. But again, there are risks. This is something that the United States has been needing to do for a very long time: is press out the maturity uh, of the U.S. Treasury, of our debt. It will be welcome, but by the same token, then how does the investing public react? And indeed, you would not think 3 months ago that you would have seen kind of the drama and the moves that we've seen in the tech sector, for example, and have the US Treasury 10-year benchmark rate be sitting at 4.50%. And yet here we are today, which is obviously reflective of what Besant is going to do going forward and whether or not we're going to be pushing out more coupons.
Okay, so I want to circle back just for one last point on the labor market situation. We have the jobs report coming this week, and with that, there's some interesting revisions happening to the quarterly consensus of employment and wages. So I would love for you to just unpack what you're looking for the general jobs report that week, and then also specific to those revisions that are coming.
So right now we think that part of the equation of the revisions is kind of a negative 800,000 in addition to what we're going to see with the final tally for births and deaths. And we know that, from all of the headlines that we've just come through a 14-year high in bankruptcy filings, and that therefore presumably once you get the actual hard data from US employers, and incorporate in all of the closings that we've seen, incorporate in the bankruptcies that we've seen, and openings not being able to offset that we could have a very major revision when we get the annual numbers out in conjunction with the payrolls on Friday. And I think that that's going to be a big focus. In fact, I think it's going to be more of a focus of the bond market to see what those revisions are than what the actual headline print is for the month of January.
Okay, and the other thing I want to shift towards is the other side of the Fed's mandate. We talked about labor market, but I want to dig in on inflation because there's something that you've been bringing up that is I find very very fascinating, and I think a lot of people have skipped. And this is basically the name of the game for inflation over the past year and a half or even longer has been shelter being resilient, compared to major disinflation or even there was a couple months of deflation in goods, and that led to substantial relief. But the fact remained that you know core services and especially owners equivalent rent was all remaining elevated, and that was leading to this difficulty to get things like core down, even super core as well. So you've been bringing up this idea of obviously OER is an imputed index. There's problems with how it's calculated in terms of it leads to this major lagged factor.
Right.
The Cleveland Fed has been bringing out this new tenant rent index. So I'd love for you to just unpack what are the difference between the two? What does it mean to go towards a market-based, core PCE from this imputed one? And then what are the impacts on inflation in terms of the forecast from a top line?
So I think that I think that market watchers need to go back to the December the 18th transcript from the FOMC, from the press conference that followed the FOMC. There was a lot of anger and disillusion with Jay Powell appearing to flip flop back and forth and back and forth. Am I hawkish? Am I dovish? Am I hawkish? What am I? Lost in the weeds, though, was the fact that he raised this inflation metric that, unlike supercore is something that was invented. It didn't exist. It wasn't like you could pull it up on a Bloomberg terminal or on an economic calendar in the past, but market-based core PCE. And the Fed's, chosen legally, the Fed has as its target headline PCE. But we know from listening to policymakers that they like to net out energy and food, just our biggest, most volatile line items, but that they prefer to focus in on the core. But if you look further at something called the core market based core PCE, that actually printed at 0.118, I want to say in December when we got the data out on Friday. And market based core PCE is nothing more than what it sounds to be. You're trying to gauge real time market pricing. The problem with the construct, the way it's always been reported, is that it also had the imputation of owner's equivalent rent in it. So when you back that out and when you listen to what Powell said on December the 18th, and that is that we should be tracking new rents in the economy because that is what rent shelter inflation actually is, as being as real time as we possibly can be. So when you substitute out OER and substitute in the Cleveland Fed New Rent Tenant Index, you actually find out that on a year over year basis, that construct is up 1.25% year over year. And 1.25% year over year is definitely lower than the Fed's 2% target. So this is something that really got the bond market's attention when Christopher Waller, who's considered to be kind of Jay Powell's chief lieutenant and speaks most closely, his views are most closely in line with those of Jay Powell. He reiterated that this is what the Fed is focused on right now, or at least this is what Waller and Powell are focused on, is this market-based core PCE with rents. And so if they think that inflation is at 1.25%, then it's certainly making continued progress and has already actually fallen below the Fed's 2% target. And this brings us back to the most recent press conference and the fact that Jay Powell almost shocked the markets by swatting away the material changes in the statement that implied that the Fed was not making forward progress on inflation. And he said at the podium, all that was minor tweaking to the language. It wasn't meant to broadcast a signal. So he used the word signal, and then he fell back on, again, this construct that's exists for a very long time. I want to emphasize that, being in a very well-behaved manner, and the fact that if you lose a job, it's very hard to find a job. So he brought in two factors at the podium. One, inflation's actually below the Fed's 2% target. And two, if you lose a job, it's very hard to find one. You only have a rising quits rate in 12% of US states right now, meaning job insecurity is the primary driver in 88% of US states. And he was nodding to all of these impediments to finding work and how very tight the labor market, loose the labor market is right now. So he spoke to both mandates, employment and inflation, at the podium. You just had to understand what he was saying.
Scale is shaking up the blockchain game. With a gas-free, invisible experience, it's the perfect solution for developers and users alike. Forget unpredictable fees. Scale's innovative model ensures smooth, cost-free transactions, saving users over $9 billion so far. With over 46 million active wallets, Scale is proving itself as the go-to blockchain for gaming, AI, and more. Explore the Scale ecosystem at scale.space/ecosystem and follow their journey on X at Scale Network. Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. Yeah, to your point, this construct is not new, but obviously it's new in the way that Powell was talking about it since December. So I'm curious, what do you think changed there? Because obviously there's been a lot of market participants who have said, hey, if we just swap out OER for something more real time, we're at 2%. And there's been plenty of people saying that for a while. But what do you think is the shift that occurred that they're actually talking about that at press conferences now?
Well, I think part of the dynamic has to do with the Fed's prior actions. They hoovered up a gigantic portion, 39%, I think, at the peak of the mortgage-backed securities market, when they were in their quantitative easing lower for longer mode. And what that did, the byproduct of that policy, was that you have the lowest mobility in the history of the United States, the fewest numbers of Americans moving uh, from one house to another. And when you have mobility as low as it is, then the lagged effect when you see shelter inflation manifest in CPI, which tends to be, according to Fannie and Freddie, about 6 quarters, you actually lengthen that lag effect out even more because so many Americans don't want to get rid of their very low coupon 30 rate fixed mortgages. And so for the Fed to shift its view to a more real time metric that incorporates 500,000 multifamily units coming online in 2023, another 500,000 coming online in 2024, and more than that coming online in 2025 and going forward. Ergo, you're seeing rents come down in real time because that's just a reflection of supply and demand. What Powell was trying to do by shifting the view to rents and away from owner's equivalent rent was to nod to the fact that mobility is as low as it is, and that therefore the Fed could be caught wrong-footed and not responsive enough to to disinflationary pressures if all it was going to follow was owner's equivalent rent.
Yeah, I asked that because it's interesting that this shift happened during this year where they're going to be reviewing their monetary policy framework. And to your point, within their mandate, it says headline PCE. Do you think this is, they're stepping towards them saying, hey, we're going to focus on market based core PCE because it's more reflective of like where the real time data is?
I think that that is the message. And because it was reiterated first by Waller and then by Powell at the podium, I think that they're trying to be consistent. And when I say they, it's a very small number of those on the committee because there are obviously many others who fought hard to get the language to be more hawkish in the statement, who are concerned with the specter of tariffs potentially being inflationary. But what we know is that Powell avoided dissent in allowing for the language of the statement to be altered and to sound more hawkish than just to get up at the podium and swat it away. It's speaking in favor of the more dovish members of the Federal Open Market Committee who are maybe seeing his way to let's follow a more real time markets metric going forward and let's focus more on rents.
Okay, so obviously the service side of inflation and shelter, et cetera, it's looking like it'll continue downwards. And what I referred to earlier is that we've seen a lot of the disinflation come from the goods sector. That's looking like it's starting to rebound. We've also seen some interesting ISM data that's come out today, where we see the manufacturing PMI come out above 50 for the first time in 2 years. So I'm curious, how are you thinking about this? What's looking like a rebound in the manufacturing sector, and how can that trickle down into potential goods inflation and just the general growth story and outlook for the U.S. economy?
So what's interesting here is the idea of follow through. And are we going to get follow through? Was this stockpiling as a hedge going into the tariffs? And if that was the case, then we would see kind of a pop in buying, a pop in new orders, uh, you know, cruising over that 50 benchmark between expansion and contraction. But we would have had to have seen backlogs pop north of 50 today in order to have a validation of what we're seeing in new orders. And we didn't. We actually saw backlogs decrease further into contraction at 44.9, which is below the recessionary 45 level. So backlogs are indicative of future demand that you've got in the pipeline, future new orders, future demand for labor. And we're not seeing that. We possibly could, but again, the follow through is not there right now. And we actually saw a similar dynamic play out in the S&P Global US manufacturing report that preceded the ISM report, which also showed further contraction in their backlogs. So we're going to have to see if there's follow through. If there's not, then this was simply a reflection of stockpiling.
Is there any way we could tell that, or we just have to wait and see it out and how the data comes?
We're really going to have to wait and see. We saw it in very real time with the January regional Federal Reserve manufacturing surveys. They were flagging that we were going to see a big pop in new orders, and they were flagging that we were going to see the headline ISM pull above the 50 mark. But we did not see, again, a follow through of this with a lot of strength in the backlogs showing you that we've got pent up demand going forward. We've got orders that we could not satisfy. reflected in the backlogs. We'll find out very quickly because Empire Manufacturing is the first out of the gate. We don't have to wait very long for that to be reported for the month of February. But the regional Fed surveys for the month of February, that's going to tell us whether or not there's been real follow through to what we saw in the month of January.
Yeah, it seems like it's going to set up for an interesting potential head fake here. Even looking at like the Atlanta Fed GDP today came out at like 3.9%, but you look at that and it's like a lot of that was driven by this ISM data. And, if that is a head fake, then this whole thing is a head fake. So I would love to hear your thoughts on, yeah, just tying this into the broader growth outlook. Obviously, we had the GDP print come out last week, 2.3, which was lower than expected. Looked like mostly this import export story. But when you look at the consumer spending data, we came in at 4.2%. That's fairly robust. So I would love to just hear about how you're thinking about that broader growth outlook with this as a context.
So what we did when the GDP report came out, and this goes back to some work that was done about a year ago at the Dallas Fed that showed there have been a handful of instances in the post-war era where you've seen consumption continue to rise through recession. So what dictates whether or not the United States economy is in expansion or contraction in 93% of the episodes has been business investment. And so that is where we focus our sights going forward, because that's the most leading of the indicators in terms of, is this recession? Is it not? And what we saw was that we saw business investment contract for the first time really since 2020. And that was a big signpost for us, that negative print in front of business investment. When you net out yet another imputation called intellectual property, from that, the print was negative 0.46 for the fourth quarter of 2024. That's relevant because if we're seeing a contraction in business investment, that's what's going to be the chief determinant of whether or not the US economy is in recession or not.
Yeah, I would love to just hear a bit more about this idea that there could be different types of recessions because, in 2022, we had 2 quarters of negative GDP prints. One got revised back to positive, but that was happening during a time where we've had a red hot labor market. And it looked like a lot of that had to do with idiosyncratic factors, perhaps less so just, the core nuts and bolts of consumption and investment. So, yeah, I would love to hear like how were you thinking about that 2022 era? How are you thinking about this phase where it feels like we've been floated through by government expenditure? And then to your point now, it sounds like, when you look at the labor market data and what you're seeing in investment, it feels like we're getting closer and closer to that more robust type of recession. Is that how you're thinking about it?
Yes. To answer your question succinctly, the answer is yes. And we have seen strong consumption. We have seen credit card spending continue to be very strong. We heard that from the major credit card issuers in their fourth quarter earnings. We have seen buy now, pay later really come on strong in the United States. That's been a big boost for lower income earners being able to maintain their spending. We've obviously seen a wealth effect because of the stock market remaining near all-time highs. And we've also seen we're coming through a period of time when people who were in their retirement years were able to collect great big chunky cash incomes from from what they had in savings. So that a year ago we were talking about being able to lock in 5.5%. That's a decent amount of money, especially when 70% of interest income is immediately spent directly back into the economy. Now you can get 4.0%. So a much lower amount is coming in terms of interest income. And we saw that with LVMH reporting disappointing headline revenues for the fourth quarter, which may have come across as a surprise to some. But the distinguishing factor here is the fact that when you have a dollar of increase in your net worth tied to your stock market portfolio, you only tend to spend 2 cents of that increased wealth as opposed to 70 cents of interest income that you're making. Of course, that's come down because the Fed has lowered interest rates. But borrowing costs for lower income, lower credit score consumers is certainly not moved. And we're still seeing crazy high levels of credit card interest rates, auto loan rates. And that is going to act as a governor on consumption going forward at a time when the wealthier's interest income has also come down appreciably. So two different factors at work here. But we're, as we see credit card charge-offs continue to rise, as we see auto delinquencies, car repossessions, what I'm writing about this week, continue to rise. So that's going to be a squeeze on the lower end. Whereas on the higher end, there's going to be some nervousness because they're not collecting as much as they were in interest income a year ago because the Fed has lowered rates.
To round out this conversation, I want to circle back on the Fed and something you mentioned earlier about how there's these concessions for the Hawks or the Doves, whichever direction it's going. And it just, I want to get this high level view from yourself about it, how it feels like there's a higher degree of fragmentation in the Fed right now than in history. You have the Goolsby camp, which is that we're significantly restrictive and we need to cut. You got Beth Hammock and Bowman, talking about how basically saying that the cuts were a mistake, effectively. Then you have the core group of the Wallers and the Powells, and it feels like it's going to be a fragmented year. And you brought up how perhaps to appease the Doves, and the Hawks, they added some concessions into the press statement, but in the press conference, Powell was just able to swat it away. So, yeah, just curious, like from a high level for the next 12 months, like, do you agree with this increased fragmentation, and how do you think that's being dealt with internally, especially with the pressure of Trump coming in as well, pressuring?
Of course, and Trump surprised everybody over the weekend by saying that he agreed with the Fed pausing in January. So that was just, if you want to add a new twist on top of everything else that you're seeing, he actually gave the nod to Powell's strategy, if you will. Powell's in between a rock and a hard place. He's in office until May of 2026. So he's got another 7 meetings this year, and he's got several meetings in 2026 where he's going to remain at the helm. And walking this tight line in between the Hawks and the Doves is going to become increasingly difficult, especially if we start to see job losses coming out of the government sector, which is going to make the Doves even more reticent and making the Doves say, we need to be lowering interest rates at the March meeting. And we need to be talking about 4 or 5 interest rate cuts in 2025, not 2. And the flip side of that's going to be is as long as there's continued anxiety and concerns that tariffs are going to ignite inflation, he'll be hearing that from the hawkish contingency on the committee going forward. And of course, the risk going forward is that he's going to get dissent no matter what he does. So, and that's going to make for a lot of fireworks, as we should be seeing fireworks when you're talking about the head of the Fed, Jay Powell. Time is ticking in the back of his head. May 2026 is right around the corner, and the market's focus is certainly shifting to, is Michelle Bowman going to be named vice chair of supervision and regulation and friendlier towards Wall Street? Is it possibly going to be a Kevin Warsh, whose name's going to be coming up to be the next chair of the Fed? And is he going to be more of, well, I'm in Trump's camp. He likes low interest rates. I like low interest rates. There's going to be a lot of push and pull going forward as the clock continues to tick in the background with Powell's last days and months in office.
I'm curious what you think is a core driver of this fragmentation. Is it just a disagreement on where the neutral rate is, or is it a disagreement on like political ideology? I mean, you look at the inflation expectation surveys, and it's just like a cross between Democrats and Republicans. And is that where the line is between the Hawks and the Doves? Does it line up with the political ideology, or is it something more to do with an economic model of disagreement on neutral rate?
Well, I think all of the dynamics that you're describing are at play depending on the player. And that's what's really crucial here is Trump's going to have a say come January in terms of who replaces Adriana Kugler on the board. It'll be interesting to see who his choice is there, and who gets that next 14-year term. But all of the things that you describe are of import. Powell mentioning the median duration of unemployment and nodding to how very fragile the job market is right now. There is an employment mandate. Looking at the past through the prism of the 2019 FOMC transcripts, the fact that tariffs back in that episode did not generate inflation that was of any lasting presence, but rather a slowdown in growth. And whether or not Trump 2.0 tariffs are going to be stronger or more of a shock to the system, generate more inflation to the points of the Hawks going forward. Any of these can play out. And that's what's going to make monetary policy making so very difficult going forward is they're not looking at real-time data. None of us are looking at real-time data and able to parse out what the effect of, if it's going to be Mexico on hold for a month, but yet tariffs are going to be implemented in Canada. Is Europe next? Is is Trump trying to make a greater statement when it comes to the Panama Canal and China going forward? And is that really the target here? We don't know. And we won't know until we watch the data slowly play out and see the reaction in the bond market, see the reaction, which is more real time, see the reaction potentially in the stock market. And again, if the Fed starts to lower interest rates more, then are you going to make the skittish 70% of Americans who own 40% of the stock market? Are you going to be compelling them to begin to liquidate their positions going forward because they want to make sure that they have plenty of principal to live on in their retirement years in a situation where you've got falling interest rates? So there are so many different factors that are playing into a very difficult job for Jay Powell and the other 16 members of the Federal Open Market Committee.
Yeah, to say the least. Do you think I know when he got renominated, you were talking a lot at that time about how he wants to, have a good legacy at the Fed. Do you still think that's his driving factor for the next 12 months here?
Well, I think it's a more difficult goal if his goal was to have a more longstanding legacy. We saw that with the resignation of Vice Chair of Supervision and Regulation, Michael Barr. And that was the legacy that I was often speaking to was, is it going to be possible while Powell is in office to push through the central clearing of treasuries, to make the risk-free assets safer on the world stage in terms of trading, to begin to regulate the shadow banks? And a lot of that has been called into question and indeed looks like it's going to fail. And so the possibility of indemnifying his legacy is it's much lower than it was going into a potential different outcome of the election, whether we like it or not. We're seeing a changing of the guard at the Treasury. We will see a change of the guard at the SEC. We're going to see a watering down of the Basel III endgame capital requirements. And presumably, we're also going to see much less in the way of regulating the shadow banks. All you have to do is connect the dots to some of Trump's biggest campaign individuals who gave the most to his campaign, who would have possibly lost the most had we seen an introduction of regulating some of the largest players in the shadow banking world, some of the largest hedge fund players, some of the largest private equity firms, private credit players. Doesn't look like that's going to be the case going forward.
Okay, so just to round out and finish up here, just getting a bit more into the tactical weeds of monetary policy. Do you think that pausing was the right move during this recent meeting, especially within the context of there's no February meeting where we're basically on hold until March? How are you thinking about these next 2 months here?
So, this could be a repeat of what we saw over the summer months when they paused in July and ended up effectively regretting that by going into the September meeting with a 50 basis point cut. So, if we do start to see weakness in the job market going forward, if there is a greater recognition and appreciation given Fed communication of this new construct of market based core PCE using rents instead of OER, a recognition that, we're actually not behind the eight ball, inflation is lower than the 2% target. So if we start to see more evidence of this, if there's not an immediate impact of the tariffs on, let's say, goods inflation, then you could see the potential setup for a market which is only pricing in about a 15% probability of a rate cut in March, begin to price in a much more aggressive Fed going into this March meeting. There's a lot that we have to see in terms of data releases between now and then. February could prove to be not a short month, but a long month as we wait out a lot of the calendar to be released going forward. There's not one, but two payroll reports that we're also going to have in hand before the Fed meets again.
Yeah, I like that framework. It's going to be a long month on the shortest month for sure. Danielle, always great to get you on the show. Really appreciate you coming back here. That was a great conversation. Where can folks go if they are not subscribed to your work or anything?
So please come to dmartinobooth.substack.com. We're running a promotion that goes along with Substack's new, with their first ever investing summit that I was a part of. And if you don't follow me on Twitter already, please do at DiMartino Booth. And if you're an institutional investor and would like to find out more about what we provide institutions, our Bloomberg chat room, what have you, just Google QI Research, QI Pro, and I'm happy to talk to you one-on-one about that as well. So, but thank you for that offer.
Awesome. All right. Thanks again.